Good morning, everyone, and welcome to this Kepler Trust Intelligence Alternatives for Income event 2022. This week, we're running a series of webcasts with managers of trusts offering different solutions for those looking for a decent income. To kick things off, in a minute, we'll be hearing from Adam English, manager of M&G Credit Income Trust. MGCI invests across public and private debt markets, thereby operating with a much more diverse set of opportunities than a typical bond fund. One of the interesting features is that much of the portfolio is floating rate, which means that the income paid to investors on the underlying investments rises when interest rates do. That's obviously a potentially very appealing feature in the current market environment. While Adam speaks, please use the question function, which should be probably to the right of your screen, to put your questions. We'll collect them and put it to Adam at the end of his presentation. So over to you, Adam.
Good morning, and thanks for the introduction, Thomas. I'd like to take you through the details of the Credit Income Investment Trust, but before I do so, let me give you a little bit of background. First on myself, I've been working at M&G for over 22 years as a fixed income portfolio manager, and through most of that time, my focus has been on managing fixed income portfolios in the Prudential's life funds business. And we've managed to build good outperformance in those fixed income portfolios I manage over that time through some very volatile investing periods, through the great financial crisis and through COVID. And one of the ways we've managed to build that strong performance has been through investing in private credit assets, private fixed income. And that really leads to the genesis of the Credit Income Investment Trust. Because what we thought we'd do is try to open up this strategy, this successful strategy, to a wider constituents, to a wider variety of clients, those who'd like daily liquidity. And that's really why we launched this Credit Income Investment Trust. So that's a little bit of background about myself. I'd also like to give a little bit of background to the markets. I've got here a graph of the yield on a global aggregate in bond index, and the issue, and I'm sure I don't need to tell listeners this, the issue in recent years has been trying to find yield in a low yield environment. You can see getting yield from bond funds has been pretty hard to come by in the last couple of years, and with an added risk that in order to increase your yield, one is having to take increased risk, particularly on interest rates, and also potentially into credit as well. So what is the solution to that? Well, our solution really is the Credit Income Investment Trust, which I think is perfectly placed to take advantage and offer a solution to the current investing environment. First off, it is a floating rate structure. So 85% of the underlying investments have floating rate facilities. So what that means is that the income from those underlying investments will go up as Bank of England's base rates go up. So generally the benchmark they use is called SONIA, which is the Sterling Overnight Index Average, but effectively that moves in line with Bank of England's base rates. So as they go up, so does the return on the underlying investments, and so indeed does our dividend. So our dividend is based on cash rates, this SONIA rate, plus 4%. And so as the Bank of England rate increases, so does our dividend. You'll have noticed just over a week ago, the Bank of England raised its base rate by 25 basis points, by 0.25%, and from that point on, so does our dividend. So if one feels that the Bank of England's base rates will continue to increase, then you can expect an increase in our dividend stream. The other important point to note is the underlying portfolio has an average investment grade quality, so it has a good quality. So one doesn't expect to have the potential problems that one might have in volatile economic environment. And that's very important, because putting that low interest rate sensitivity and that investment grade quality gives the portfolio a low volatility. We have a low net asset value volatility, and I'll show you this quite clearly in slides to come. The reason we're able to do this is we're investing largely in private fixed income assets. So these are assets that are not generally available in fixed income funds. They tend to give a higher return than public fixed income markets, and they give a lower volatility as well. So they provide a great diversifier to a public credit fund. And the reason we are able to offer this at M&G is that we have a vast experience here at M&G. We have one of the largest fixed income teams in Europe, and indeed one of the largest private fixed income teams. And really what the investment trust, the Credit Income Investment Trust, is doing, it's levering off that significant in-house expertise in these private markets. So the net effect of this is that we're giving a stable income stream of cash rates plus 4%. Effectively, what we're giving is a floating rate, high yield like return, but with investment grade type credit risk. We are the UK's only fixed income investment trust with an overall investment grade rating. And I think that's very powerful in the current volatile markets. Looking at the structure of the Credit Income Investment Trust, as I said, we have that weighted average rating of BBB flat. We have 134 different holdings, which provides a nice diversification within the portfolio. It mitigates against any particular stock specific selection risks. We also have a low interest rates risk. That you can see the best measure for that is duration. The modified duration here is just over 1 year. So this just emphasizes the low risk but high income that we're producing within the Credit Income Investment Trust. And to flesh out that return point, on this graph, I have a green line, which is a investment grade sterling corporate yield, and a blue line, which is a sterling high yield corporate yield. And as you can see, the red line, which is the yield to maturity of the Credit Income Investment Trust, is trending far closer to the high yield. And the reason for that is that we are able to provide the additional returns from these private fixed income assets that I referred to earlier. These are producing a higher yield because they are relatively illiquid. They're difficult to source, they're difficult to analyze, and really you need the resource that M&G has to be able to find these assets and adequately invest in them. And consequently, we're able to give that kind of return that one would expect with a high yield portfolio, but with a return characteristic, with a risk characteristic more similar to that investment grade portfolios I'm referring to. So the net effect of this is we are producing a floating rate income stream. The income stream increases with SONIA, with Bank of England base rates. So we have that credit spread, that's 4%, and then the SONIA. So SONIA is currently just under 1%, and if you believe that the Bank of England base rates will continue to rise, I certainly do, then that will feed through into SONIA increasing and an increased dividend. And I think that's a very powerful position to be in the current environment when many investments will be perhaps unable to keep up with the returns with the Bank of England base rates. So we are offering something quite different from many other fixed income investments in that respect. And to flesh out that volatility point, I have a graph here just comparing to various other fixed income assets. We have a couple of interest rate sensitive indices here, the red and purple lines being a sterling corporate bond index and a gilt index. And you can see as interest rates have risen in recent months, that's actually hurt performance in those indices in recent months. Conversely, we have the green and blue lines being a high yield floating rate index and European loan indices. These are both floating rate, but they're taking greater credit risk. And you can see the volatility you take with those indices in a downturn, such as the COVID downturn. It is back in 2020. So it is quite clear from this graph, the yellow line, now the net asset value total return for the Credit Income Investment Trust is clearly a lower volatility than any of these comparable indices. And it's giving a better return. In fact, it would be a far better return if I took out fees, because all these indices I show are actually gross returns, and I am showing the Credit Income Investment Trust net return. This is after fees. So if I were to compare on a gross basis, it would be quite clearly giving a better return than these other indices, but with lower volatility. So let's drill in a little bit more into these assets that make it such a different proposition. So first off, on the right hand side on this pie chart, we have the investable universe, and the first point here is the investment trust is able to invest across fixed income markets, both public and private. So traditional bonds funds would be investing in that light blue piece of the pie. That's the UCITS universe, the public liquid bonds market. But there are other investment trusts which may invest in just one of these sections of the pie. The great thing about the Credit Income Investment Trust is we're agnostic. We'll just look at whichever part of the fixed income markets will offer the best risk return at any one time. And on the left, I'm kind of giving an indication of where we are right now in terms of that risk return. You can see that generally the better opportunities are in private ABS, or in direct lending, and in real estate debt finance. Generally, the less liquid parts of the market, but the more liquid parts of the market tend to follow what the public markets do more closely. So the less liquid ones are where one can get better returns, and then generally these parts of the market are where M&G works with the borrower on a bilateral basis. So it is just a negotiation between M&G and the borrower. We can structure the transaction to our liking to try to protect ourselves against downsides. We can talk about the returns, knowing that we are in a one-on-one relationship with the borrower, so we can extract a better return as well. So generally, we are getting this better risk reward for this reduced liquidity, and is able to give that nice return into the investment trust. The other point to make is there will be some parts of these the fixed income markets which are just not attractive at certain times, and so we're very comfortable with just ignoring those for long periods of time. So right now I am not investing in infrastructure debt or private placements, because the risk return just isn't available right now. There will be a time when they become attractive, but the great thing for our investable universe is we don't have to buy expensive assets. We can build a portfolio from whatever the best available assets are at any one time. And the reason we can do that is because we have that wealth of experience. This slide really just gives a detail of just how many people we do have working in the fixed income teams within M&G. There are nearly 300 investment professionals, and more than half of those are on the private fixed income side. And so the way we build the portfolio is everyone, you can see on this slide, all these different these investment teams will be coming to me with investment ideas, and my job is to pick the best risk reward at any one time. So we're not trying to forecast where markets are. We're just trying to look at what is available at any one time, and we tend to have somewhat of a counter-cyclical approach as a result, because when spreads are tight, when the returns are relatively compressed, it makes sense to increase the quality within the portfolio. When we think you can get paid more, when the yields are higher, when spreads become decompressed, you're getting paid more to take more risk, and at those times it makes sense to be adding risk. So it leads to a somewhat counter-cyclical approach to the way we are looking to put assets into the portfolios. And the result is the performance of the trust, and you can see that in this graph here. So I have the green line here is the net asset value performance of MGCI, and our target, which is, as I mentioned, that's SONIA plus 4%, is the darker blue line. And you can see over time we have trended nicely around the benchmark. I should flesh out a couple of points here. As I mentioned earlier, when returns become somewhat reduced in fixed income markets, I tend to reduce risk, and I was certainly doing that at the end of 2019. And you can see that the graph starts to trend down at that time. Now, by no means was I predicting the COVID crisis, but at the time when spreads become relatively compressed, it doesn't make sense to be taking so much risk. So we were well placed to go into the volatility that ensued from the COVID crisis with low risk within the portfolio. What that meant was through the spring and summer of 2020, I was able to add significant amounts of risk into the portfolio, which performed very well in the following 2 years. You can see the performance that put into the portfolio in the following 2 years. The similar situation has arisen since the autumn of last year. I've felt that that there's been a compression in credit spreads, that the returns are no longer attractive, particularly in public markets, and so I've taken risk out of the portfolio. Consequently, you can see the return dipping down somewhat, and that is a conscious decision because that gives us the ability to have a lot of firepower to take advantage of volatility within markets and to add good return for a future period. So I think we're very well placed to be taking advantage of the volatility in markets, certainly in the kind of markets we're seeing so far this year. So just to reiterate, what we're doing is relatively simple. We're investing in an underlying portfolio of private and public fixed income assets with low interest rate sensitivity, keeping that duration around 1 year, and with a good high quality investment grade portfolio. All this gives a low net asset value volatility. And this is by design. This is by the selection of the underlying assets, particularly by concentrating on well-structured private assets held to maturity. And this is a diversification to a traditional bonds funds, and it's nicely diversified in the underlying portfolio as well. And the reason we do this is it's levering off that significant expertise and resource within M&G to give a stable income stream of cash rates plus 4%. Looking at the portfolio, I won't go through all these different parts of the different allocations within the portfolio. Suffice to say, we've got 61% invested in private fixed income, and those are held to maturity assets. We've got 39% in the public markets. And it's important to have the holdings in the public markets because that's where I can change the risk within the portfolio. That's where I can reduce and add risk, as I alluded to earlier. That's where I can add where I can take the risk down, as I have been since the autumn, and add risk in better quality assets. So, for instance, you can see there's a large part of the pie chart is in asset-backed securities, ABS, and a large part of those are AAA, AA rated, very good quality assets, which I've specifically been buying recently in order to take the risk down in the portfolio, thinking there'll be a better time to be buying risk in the future. And looking at some of those private investments in a little bit more detail, Here I have an example of a loan facility that M&G worked with the borrower on a bilateral basis. So we are the only lender to this business. M&G was able to commit 75 million to this facility, and the borrower is a bakery business. It's the largest artisanal bakery business in the UK. What I like about this business is it has retail presence on the high streets, but it also has a wholesale business as well. So it gives it flexibility to size the business and the product according to end market conditions, and that gives it a good resilience. And what also gives it good resilience is it's relatively low levered. So when we signed this facility, it was about 3.25 times levered, so relatively low levered leverage, and it has performed very well since. So this is just the kind of lending we like to make. For that, we're giving it a rating of B+, which is a high yield rating, but we think there's very good very good quality return and very good performance potential in this lending. For that, we're getting that SONIA, that cash rate, plus 4.75%, and we're getting some nice fees as well there. So this is just the right kind of lending we're making into the portfolio. Another example is a refurbishment in an office in central London. First point to note, it is also a bilateral facility. This is just M&G facing the borrower. The total investment from M&G was 82.5 million. It is a central London office, which is in a very good location. So we have good expectations of the value of the building. We're lending at 60% loan to cost of the building, and when the refurbishment is complete, we'd expect there to be uplift in the value of the site, so that loan to value will go down. So we think we're well protected there. We have split the loan into two tranches, a more protected investment grade tranche and a junior tranche. The investment grade tranche we rate as a BBB-, and the junior is a BB-, and the returns are very attractive. The interest rates are SONIA plus 360 basis points for the senior, and 1,000 and SONIA plus 11% for the junior tranche. Very attractive returns for those ratings. And it's a relatively short-term facility. It's 3.5 years. So let me turn to where we are with the markets. And first off, I should start with a market outlook. You can see on the right-hand side of this slide. So if I'm talking about trying to characterize where the markets are, what is happening in fixed income, there's one word really. It's inflation. Inflation has clearly surprised on the upside. The reason for that is well known. The supply chain disruption coming from COVID has led to real issues in the reopening, and led to a lot of pent-up inflation. There's also significant commodity price inflation in oil prices, in energy, and food prices, and clearly these have been just accentuated by the invasion of Ukraine. The issue then is what happens. How does this inflation get controlled? And this is a real headache for central banks, because central banks started being quite sanguine about the inflation last year. Then they started to move their commentary to talking about transitory inflation, and clearly as inflation keeps rising, they can no longer make these arguments. It clearly is an inflation problem. And then what are their response is then what is causing problems for markets, because they are behind the curve. They are likely to have to increase their rates more than they would have liked to control this inflation, and the unwinding of quantitative easing, the quantitative tightening, is going to be stronger as well. So this combination of higher inflation and less accommodative central banks is going to create divergence in performance between sectors and individual credits and markets. All this kind of points to the importance of being active in credits in investment selection in 2022. There has been a sell-off in public markets so far this year. So spreads are starting to become more attractive, and that is something I have started to think about in the portfolio. But the big picture is still that though they're becoming more attractive, the attraction of private debt is still even greater. So the importance of having that private debt as a diversifier, and indeed providing the higher yields, is still a good one. And because that private debt is largely floating rate, it provides that nice protection against rising rates. So what am I doing? Looking at the outlook on the left-hand side. First off, the dividends will continue to increase, as I've already suggested, as Bank of England raises its base rates. So SONIA increases, so will our dividends. And our dividends can increase because 85% of the portfolio is floating rate itself. So it is just an easy pass-through of the returns on our underlying investments to our shareholders. We will continue to rotate into private assets. I've certainly been doing that so far this year. I've made another 4 new private credit investments in the last quarter, and I'm comfortable with with our dividend target. With the underlying yield of the portfolio, but also because we have a distributable buffer. As I mentioned earlier, I had been taking risk down since the autumn of last year in the public side of the portfolio, and by selling those assets, many of which were bought in the dark days of the COVID crisis, I've managed to realize nice capital gains. So that gives us a distributable buffer. So we are comfortable with that SONIA plus 4% dividend target. There is scope to increase yield if there is more market volatility in the public markets, and we're very defensively positioned, in a good position to add risk into the portfolio as and when those opportunities come through. And to that end, we have a 25 million debt facility, which is currently undrawn. And I will look to use that either if I see a large number of private transactions shown to me with the nice return characteristics, or if there is if the relative value does return to the public markets, I'll start using that to take risk into public markets. So I think we're in a very good position to ride through what have been very difficult markets across fixed income and equities, and to continue to provide a good, stable portfolio with a good, stable dividend. And what is backing this is because we have a good quality underlying portfolio of public and private fixed income assets with low interest rate sensitivity and a good quality credit quality. So that really is the in essence what the Credit Income Investment Trust is. I am happy to turn over to questions if we have any.
Brilliant, thanks Adam. We do indeed have some questions. If you're in the audience, we've got about 15 minutes available for questions, so please do put your questions now. We'll try and get to all of them. One thing I was wondering, just to kick us off, is you mentioned, Adam, that you're starting to find credit spreads interesting. How, in public markets, what would be your trigger to get more interested? Is it purely valuation based, or are you going to look for sort of the economic news to change how exactly would you think about shifting the portfolio in that way?
Well, I think it's about looking at returns through the cycle. So one thing is just taking a step back. One thing very important is that we don't try to model where we think markets are going. I think people who try to model markets will inevitably get it wrong. I think one has to just treat the investable universe as it is, rather than as you think it might end up being. So what I'm doing here is looking at what would be a good return through a cycle, and that's really when I'm thinking about when I'm looking at the returns available in the public markets, what would be a good return that would provide a good positive return through the cycle. And clearly we're moving wider. The returns are becoming more attractive. Would I say it's pricing in a recessionary environment? No, it's not. It is pricing in the withdrawal of the stimulus from the central banks. I think it probably is right now. So I think there are some opportunities coming in, but I'm still relatively cautious. I certainly am not looking to take a lot of risk right now until it becomes more clear what the direction of the economy is. And certainly I feel there is more room for volatility before I add too much risk. So I can't give you an exact number because that is a bit of a moving target, but I feel that we're at the start of the volatility rather than the end of it. So I think one needs to maintain that with the back of minds really.
And how would you say historically the private debt market reacts to market stress like that? Do you find there's a greater number of borrowers looking to tap private debt markets, or do they retrench?
Well, yeah, I mean that's a good point. They certainly retrenched to start with. So the first point is that they will be becoming a lot more cautious and worrying, and they will just be worried about funding at a higher level. So what one sees, like in the COVID crisis, was the private debt markets went quiet for a couple of months. I'm seeing that now. We have seen more volatility in the public markets and seeing less in terms of new private opportunities come through since the volatility started. What I would expect is give it another couple of months, they will start coming through, and there will be a greater demand because they will want the certainty of being able to get finance, and that's where an investment manager like M&G is in a great position. It has deep pockets and can provide certainty of funding to these companies, and that's generally when you get the nicer returns into the portfolio as well.
We had a question about, so we discussed the impact of floating rate investments in a rising interest rate environment. Could you explain what happens in a declining interest rate environment? Is it the mirror image? I guess we're looking ahead. It doesn't look likely that we're going to see interest rate cuts for some time, but over the lifetime of an investment, how would declining interest rate environments affect the portfolio?
Well, it will. So yes. So on the Bank of England's, if they do start to reduce the base rates, so will the SONIA rate, and so yes, the returns will start to fall. All I can say is that seems a very long way off at the moment, because the Bank of England clearly has got a little bit behind the curve in terms of fighting inflation, and I do fear that market expectations are currently the market is pricing in Bank of England base rates rising to 2.5% sometime next year, beginning of next year, and they're currently at 1%. So there are a good number of increases still expected by the markets, and to start thinking about significant reductions below, certainly below the current levels, I think is going to be some way off.
And with your public holdings, so the question asking how you think about trading those, do you ever hold those to maturity, or do you always look to trade in and out?
Well, it really comes down to the relative value. So if I'm able to buy an attractive asset which stays at an attractive yield through its life, I'm very happy to hold that to maturity because it fits perfectly the return requirements for our benchmark. What happens in the COVID crisis is there were a large number of very attractively priced investment grade assets in the public markets, which provided perfect return characteristics for the portfolio. And I could have carried on holding those to maturity if I so wished. However, they had performed so well that by the middle of last year, they had the returns as of that point in time had gone down. So I could realize a nice capital gain on those assets, and rather than just sitting on them through the cycle, it's much better to use the cycle to sell down that risk, lock in the profits, and then one's in a great position to be able to take more risk again, do the same thing when the prices become attractive again, and that's the way I can create nice realized gains into the portfolio and use that the cycle to the advantage of the credit income investment trust.
So, by way of a follow-up question, how important is the pull to par effect for your strategy?
Well, the pull to par effect is first off, it depends on when one's making the purchases, and certainly in the the pull to par effect is in the public side because that's where, because in the privates one is buying pretty much at par and holding to maturity till it is redeemed at par. So in the publics, as I've alluded to, I'm generally buying the assets when the market is selling off. So a lot of these assets are being bought below par. So yes, there is a pull to par effect on these, and it becomes and if it is held to maturity, then yes, there is very much the pull to par over that maturity of the bonds, and that's just part of the, and that's encapsulated in the yield at the point one buys those assets. Clearly, what I'm doing is trading through these cycles, though. So if the market is very strong in the intervening periods, you know, the returns, it won't just be a pull to par. Those assets may be trading from below par to well in excess of par, and that's what I'm saying. In those instances, when they start trading well in excess of par, it becomes attractive to sell those assets and start reducing the risk in the portfolio.
Now, could you tell us how ESG plays a role in the portfolio?
So it does. It's very important, though. I think I have to make it clear this isn't an ESG portfolio. It isn't the prime part of the. It isn't a prime objective as part of the portfolio. However, at M&G we have ESG embedded in all our credit analysis. So every investment we make, the analyst will be giving an ESG view in every part of in every part of the credit process. So, and it's very important because the ESG, if a credit is failing on any ESG characteristics, then it becomes higher risk. One is becoming it's potentially a worse investment. So one has to consider ESG very actively in every investment decision I'm making. But it is feeding into the risk reward on those individual investments rather than a blanket ban on any particular ESG angle. Oh, sorry, I should add though, we do have blanket bans on names that are in breach of the UN Global Compact, and we also have a coal policy exclusion as well within M&G. So there are certain credits, a small number, which we will not invest in of any sort.
Turning to the structure of the trust, obviously volatility in markets can sometimes be exacerbated in investment trusts by the share price discount. Does the board have tools to limit that? What's the strategy?
Yeah, maybe that's a very good point, because the board is very much aware of that, and because we are emphasizing stability in the underlying portfolio and stability in the dividend, we want to try to give shareholders stability in the share price. So there is an active share price management policy that the board have communicated to the market, and that is to try to maintain the share price within a limited bounds within around the net asset value. So if there is a discount to that net asset value, we will go out and buy shares in the market to keep it within that bound. And if it rises, if the premium rises conversely above the net asset value by a very significant degree, we will sell shares into the market. So we're trying to keep somewhat close to the net asset value. Effectively, we're trying to create some of the dynamics of an open-ended fund, but in the form of a close-ended.
We've got a few more minutes, so if anyone has a final question, please do add it now. There's one coming through on your AAA holdings, particularly in asset-backed securities. Are they also the equivalent of dry powder? What sort of yield do you get on those?
Yes, they are. They're very much dry powder. So as I alluded to, I was selling worse rated assets through last year, but I needed somewhere to invest them. So I'll give you an example. After the COVID crisis, I was able to buy triple B corporate bonds with spreads between 2 and 3% over the benchmark. By the autumn of last year, they had rallied back in price so far that the yield had that spread had fallen to 1% over the benchmark. So and that led to a very nice price return. I mean, those assets would have returned somewhere in the teens to 20% return for the portfolio. So it's very nice to sell those assets and realize those capital gains. But what I was doing is rotating into those AAA assets, and I could buy, for those who are aware of these, CLO AAA paper, which is offering a floating rate return plus 1%. So in terms of credit return, similar to those triple Bs that I was selling, but much better quality. And so indeed, those assets I continue to hold, but that is dry powder. Those are very liquid, very easy to sell, and the prices don't move substantially. So what I can then do is sell down those AAA assets and buy more risky assets as and when I see the appropriate value come through.
Probably the final question, unless anyone wants to be very quick. Does the manager invest in his own cooking? I think it means eat his own cooking.
There are disclosures on the share register of the boards, and they are all holders of shares. I certainly am as well. I think in a difficult investment horizon, in a difficult time to be investing in all markets, I think this is a very attractive time. So I'm very much invested in the shares.
Great. Well, thanks very much, Adam, for your presentation, and thank you to the participants for your questions. I hope that was useful and interesting. Please join us tomorrow for the next session, which will be discussing Invesco Bond Income Plus. So thanks very much, Adam, and hope you have a good day.
Thank you.
Bye, everyone.
Bye.